Well, good morning, ladies and gentlemen. Thank you for coming, and it's a really good turnout. I am very sure that you all are very much concerned about the current state of world economy. In fact, you must be quite worried about the current world economic situation. I don't recall any other time before when the world economy is under such various uncertainties and risks. This year began with various turbulences in international finance and international economy. Well, this morning we have the special guest speaker. He will enlighten us what's going on in the world economy and the finance. He is I suppose, the best person who will entertain us on these issues. Mr. Hong Tran has been with us a number of times before, so I don't think he needs a long introduction. But I just want to say that he is with IIF in the Institute for International Finance, which has members of all international big and important banks. And so IIF plays very, very important role on behalf of global banking community. The Hong Tran has been with this IIF. Currently, he is executive managing director. And before that, he spent 5-6 years at the IMF and 12 years in Deutsche Bank, and he has been working in the areas of capital markets and global finance in particular. So he is the best person to talk about the turbulent global economic, particularly financial situation we are facing today. He's on his way to Shanghai this afternoon, and he is busy, and he's very popular as a speaker all over the world. Well, with this very short introduction, why don't you join me in thanking him for the talk?
Well, first of all, let me express my gratitude and thanks to Chairman Il Sagong and colleagues at the Institute of Global Economics for hosting us and organize this early breakfast meeting. I was sharing my remarks with colleagues at my table and saying that in my whole career, Seoul and Korea is the only place where you have a 6:30 breakfast meeting and well attended by everyone. So even in the US, if we organize such an early breakfast meeting, we will be hard pressed to get enough attendance. Dear colleagues, the title of my short presentation to you this morning, and I'm happy to entertain questions after this, is Bear Market, Central Bank Liquidity. That is a polite way that I try to use instead of central bank super activity or hyperactivism, and deteriorating fundamentals. The last words is really the key theme running through the presentation, and that is what I want to leave you with. It's deteriorating supply side fundamentals of the global economy, and that's why we see the kind of things that we have seen. First, bear market in perspective. We have had sharp turmoil and sell-off in financial markets, particularly equities, since the beginning of the year, starting from China and then spread throughout the world. But I would like to put it in perspective a bit longer term so that you see where we are. So 3 takeaway points here. Number one, We have seen some stabilization and recovery in the past 10 days or so. Don't be too complacent, because in my view, those are just short-term, normal market up and down, because the underlying problem that caused the sell-off in the first place is still there, not being resolved. And there's nothing new now compared to at the beginning of the year when the market was under pressure. And to reinforce this point, overnight, we had the latest February PMI Purchasing Managers Index released for Europe, US, Japan, and China. Everywhere down significantly across the board. China, in particular, the PMI index compiled by Minxin show manufacturing down to 37.5. That is way below the 50 line. Services sector, which has been until now the hope for Chinese economic stability because they are getting bigger, more than half of GDP, they are growing more sturdily, also declined 37.5. That means the main challenge that we have causing the sell-off, lack of growth, lack of demand, and slow recovery is still with us. If anything, seems to be accelerating. Number two, if you look at the red line, mature markets, despite the fact that since mid-2015, we have a bear market in the sense that indexes declined by 20%. It's basically a very mild and not that major correction from the long-term trend. So we are still ahead in terms of recovery since 2009. The question is, can we stay there, or there will be more overshooting on the downside to come? Number three, which is more interesting point, is what has been happening with the emerging market world. And that, going forward, will hold the key to understanding development in the global marketplace. Here you see since 2003, between 1999 and 2003, equity markets in both regions behave more or less in sync. They move more or less the same way. However, from the early 2000 until the crisis, 2008, and then recovery from the crisis until 2011 and basically 2014, what we have seen is a quite significant outperformance of the emerging market equities indexes compared to mature markets counterparts. You see huge increase, almost 4.5 times better performance by the emerging market financial markets over those years, 2003 and 2014, more than a decade. That was the golden days of the emerging markets. That was the day where the terminology BRICS was coined. That was the day where growth in emerging markets exceeded growth in mature market economies by 6-7 percentage points. The highest growth differential was in 2008. And that attracted huge amount of capital inflow into emerging market and causing emerging market countries to perform very well. What we have seen since then, particularly 2014 and now, with the sharper decline of emerging market equities, is the correction of that, in my own understanding, euphoria. It turns out that the key motor of the superior performance in growth and financial markets of emerging market countries in those years were commodity prices. Commodities price went up strongly from 1999 to 1911, 85%. Everything went up. And since 2011, commodity prices went down, about 60% by now, everything went down. And the hope that the emerging market countries could use the period of strong growth to make changes, to make structural reform, to change the institution, to improve the economy, to become a diversified, modern economy, to cope with bad times, by and large, has been disappointed. There are a few good examples here and there, but by and large, many emerging market countries simply failed to use the good time to do what's needed to be done. So the key point is the blue line will come all the way down to meet the red line like it used to be a decade ago. And therefore, for emerging market, there is more room for disappointment and underperformance. Another key distinguishing point of this market sell-off is that the banks bear the brunt of the sell-off. If the overall index declined by 20% or so since the peaks in mid-2015, many banking sectors in US, in Europe, in Japan, and emerging market countries declined sharply since the beginning of this year, as you can see on this chart. So everyone is coming down. US is a bit less relatively compared to others like Europe, but interestingly, Japan has also shown a very sharp downturn, and also emerging market banks. So what's going on? The key things we have to keep in mind here is that slow growth, high debt in many countries, particularly emerging market countries, causing non-performing loans to rise and credit costs to rise, higher regulatory requirements by own banks, altogether produce slow profit growth for banks. So basically no profit. So that is what investors are realizing now. Banks, given the environment that they operate in, both regulatory, economic, financial, has very poor opportunity to realize income and profit, and therefore they are being sell off. And the sell-off in equity markets also spill over to the concern that for some banks at least, their subordinated debt, such as COCOs, the contingent convertible bonds, may be in difficulty, and you see here the significant increase in the spread in subordinated debt. Nowhere near the 2012 in case of European banks of the European sovereign debt crisis, but getting closer to the peak that we saw in 2009 during the great financial crisis. So things are not quite right. Things are still under stress. And this is really the key to the whole thing, low return. Before the crisis, banks at least offer to investors interesting model, high risk, high return. Return is very volatile, risky, subject to many changes in the marketplace, but quite high. If they do it right, they can have very significant profit, so high risk, high return. After the crisis, I think that the concern and the intention of policymakers is to move away from that model so as to minimize the risk of crisis and to minimize the risk of using taxpayers' money to bail out failing banks, and move toward a low risk, low return banking environment, which is thought to be safer and contributing to steady, stable growth of the economy. I think that what we have seen is a reality check on that vision. Only 50% or half of that vision has been realized. The low return has been realized, but the low risk has not. Because we have to step back and think, banks are not utilities. Banks cannot be made into the utilities, water, utility, power generator utilities. Utilities can have regulated rates and regulated return on capital, and therefore they can show, despite low profitability and low return, very safe and reliable and stable income. Banks cannot be put in that mode. No regulators can guarantee stable, reliable returns to banks. Even in a simple banking business, lending to business, they are utterly dependent on the underlying local economy. If the economy is doing well, the banks are doing much better because they are high beta play on the economy. But if the economy is in recession, banks going down. Now, if they do more sophisticated products, investment banking, trading products, the environment is getting very difficult. Markets are very uncertain. Regulatory burdens getting higher. And on both sides of the bank business model, normal, simple banking or sophisticated wholesale investment banking, challenges to generate decent income is getting more and more difficult. US banks seem to be trying to cope with that, and even though their return on equity now is around 9%, half of what they used to be before the crisis is European banks that we really have to be concerned about. They basically, since the crisis, have not been able to consistently provide a return on equity above their cost of capital. And this situation is not sustainable in the long run. And that is reflected in the low valuation that market participants have given to banks. On the left-hand side, you see the price to book ratio by country. US is still better with price to book average about 1 time, but that hides a lot of banks already trading at below book value. But basically elsewhere in Europe, UK, Japan, it's well below book value. In the case of Greece, because of the crisis, it's well below book value. In the case of Germany, it's because of 1 or 2 major banks suffering from very low valuation. On the right-hand side, again, I refer to comparison between banks and utilities. You see that at the moment, banks have the lowest valuation in terms of price-to-book ratio compared to any other sectors of the economy. But you compare banks and utilities, the 4th line on the left from the banks. Even though utilities globally show the same rate of return on equities, about 5 to 6%, they enjoy far higher multiples in terms of price to earnings and price to book. And it is clearly the way for market participants to say that, look, banks have low return, but not low risk, still high risk and low return, which is a very difficult combination to maintain. This concern about ability to service debt has spread also to the emerging market countries. As I said, and I will come back later, they have accumulated significant amount of debt over the past 8 years, record amount, particularly by the corporate sector of emerging market countries. And this spread is steadily rising, and I think that personally it will continue to rise even more going forward. So that's the first part. Second part is contributing to this sense of uncertainty, volatility, and disarray is action by the central bank. After the great financial crisis, action by central banks such as the Fed, Bank of England, and so on, did contribute to stabilizing the situation, reduce the panic, set the stage for recovery. And in the US, particularly, recovery has been going on steadily since 2009 until now. Subpar, but steady recovery. I think that central banks' action are now getting into diminishing return territory. They have had huge amount of liquidity. They have pushed interest rate down not only to 0 but to negative area by many countries in Euro area and Denmark, Switzerland, Sweden, and Japan. And there's increasing question about if the Fed will follow up with that and push rates eventually to negative territory as well. It is diminishing return because the 3 things that central bank easing activity has hoped to achieve is not working anymore. One is by easing, central bank hope to depress the value of their currency. It doesn't work anymore. I will show later on, after Bank of Japan announced their negative policy rate on January 29th, from then until now, the yen is 7% stronger, not weaker. The equity market is 6% lower, not higher. So it ain't work anymore. Second, in terms of encouraging borrowing, hasn't worked that well. In Japan, since 2012, despite significant intervention from Bank of Japan, borrowing remained flat. And last but not least, supporting risky assets and borrowing in the environment of overall already high level of asset valuation and in the context of high debt, you can only borrow growth from the future. If central banks are successful, if central bank can stimulate more creation of credit, it can support growth in the near term, but at the cost of creating a bigger problem in the future with higher level of debt. And you can see that's why central bank, in my view, contributed to significant increase in volatility. If you look at this chart, we are way above the high level of liquidity we experienced during the depth of the financial crisis back in 2009, particularly yen interest rate volatility. And then with that negative yield, we have almost $7 trillion of mature market government bonds offering negative yields below zero. Another 9 trillion giving you between 0 and 1%. In other words, it is a very hostile environment for banks. Banks rely on positive yield curve to get income from maturity transformation. They take in short-term, lower interest rate deposit. They lend out long-term. They get the income from the positive yield curve. If the yield curves, because of central bank activities, not only become flat, but flat close to zero, then there's a big source of income for banks has been reduced. And that, again, contributes to the sense of how bank can demonstrate a convincing business model that is one that can earn decent return. Japan, I said before, after the dotted line, January 29th, perverse reaction. But the main central bank that everyone should try to understand now, in my view, is no longer the Fed. It's the Chinese central bank, PBOC. They do many things, and at the end, it is very difficult to understand what is it that they want to achieve and how, and the impact, therefore, has been quite creating uncertainty. I call this impossible trinity in the sense that they are falling into a classic trap of trying to do too many things, basically 3 things at the same time, which has been shown to be quite impossible. They want to liberalize their capital account and let the exchange rate to be set more by market influences, both of which are conditions for them to persuade the IMF board to include the renminbi in the SDR, which they succeeded. But third, and more importantly, they still want to have a domestic monetary policy geared towards supporting growth in China. They cannot have all 3 at the same time. And therefore, what they have been doing is really failing to say what is their priorities. What is it that the one thing that they want to achieve and how they achieve it. Because it's clear that they cannot get all 3 things. But they have not been very specific as to what of the 3 things they want to drop. Because they have to drop something. So I think that uncertainty will be around with us, and that will be at the back of market nervousness. Here, since late last year, China officially announced that they will try to use a basket of currency, about 13 currency, the blue line, to reference the renminbi. But it is not clear, and even with the latest announcement from People's Bank of China, if the reference is hard pegged to the basket or a dirty float against the basket. At this point, it's not clear. In the meantime, the key rate that many market participants and for countries in Asia, the renminbi dollar exchange rate continue to weaken, and there's widespread expectation that it will continue to weaken to at least another 10-20% further. Question is the timing of that trajectory. It's very likely that China will keep it stable in the near term, but the underlying pressure will remain. And because of the effort to keep currency stable or engineer the weakening in a very gradual way in the near term, they have been intervening in the foreign exchange markets, selling foreign exchange reserves, and therefore reducing the size of their balance sheet by selling FX assets significantly, as you can see in the past year. Since 2014 until now, almost $1 trillion equivalent of reserves have been sold. That has a direct impact on reducing the monetary-based growth of China. So by intervening in the FX market to keep the decline of the renminbi gradual, they shrink their balance sheet and withdraw liquidity from the domestic economy. However, they want to have a accommodative monetary policy at home to support growth. And therefore, they compensate for that by actively using more open market operations, which now they will do on a daily basis. As you can see, since last month, adding huge amount of reserve into the system. These things cancel out. The net outcome is the overnight interbank rate seem to be going up, not down. It should be going down because they need easier conditions to support the economy. Nevertheless, given all of these developments, borrowing and credit creation continue, and his is one of the key Achilles heel of the Chinese economy, debt. If you look at this chart, total social financing continue to grow by 13% year over year, and in January it's a big jump that we don't show here yet because it is quarterly data we use here. In January, 3.4 trillion renminbi new total social financing increase. To the extent that the pace of growth in total financing is almost twice or more than twice the nominal growth rate of the Chinese economy, debt is going to increase. So two observations here. Our latest estimate put Chinese total debt to GDP at 277% end of last year, 2015. In January alone, the increase in financing on a net basis in our estimate add another 3 percentage points to the level of debt. So at this point, Chinese debt is about 280% of GDP, and there is no peak in sight. In other words, it will go on and continue to rise. Of course, cannot be sustained in the long run, but the question is, when is this long run going to be? So if you put everything together, slower growth, and a huge amount of borrowing, concern about profitability of Chinese companies, and the state of the equity markets, that really account for continued net capital outflow from China. We estimate in January another 113 billion net outflow from China after the significant outflow that we have seen in the past year. And that really is the story behind the overall net capital outflow from emerging market countries. If you look in the chart, the red bar in 2015, the bulk of the outflow from emerging market countries came from China. And this year, 2016, we estimate that the outflow from China will remain. There's some small re-inflow to emerging market countries, but overall for emerging market countries, still significant net outflow. It is very important and add to the headwind to many emerging market countries, because net capital outflow means tightening of financing conditions in the country, making it difficult for companies and households to support their activity. So overall, global financing conditions difficult, net capital outflow headwind. Third one is debt overhang, as you can see here. If the crisis in 2008 was thought to be caused by too much debt and the need for deleveraging, what we have done since then is to add even more debt. In the mature economies, the green light government debt increased significantly from less than 70% of GDP collectively to more than 100% of GDP, caused by fiscal stimulation and fiscal support to the banking sector. In the emerging market economies, everyone go out and borrow more. You see every line going up. The blue line, household went up very strongly from very low base, of course, but very strongly. And in fact, in some countries, the level of household debt to GDP is as high or if not higher than in some mature economies. Korea, for example, debt to GDP around 85%. Debt to personal disposable income is, of course, much higher. And I think that's one of the area for concern. Non-financial corporates, however, is the key. In the past 8 years, corporations in emerging market countries, and if you look at South Korea as well, significant increase in debt to GDP. In South Korea, it's 150% corporate debt to GDP, one of the highest in the world, and on par with China, which is in our estimate about 154% of GDP in terms of corporate debt to GDP. High debt means two things. You cannot borrow much more going forward if you are that highly indebted. Number two, if you cannot borrow that more going forward, you cannot support activity. And the third point is that emerging market countries and mature economy suffer also from this diminishing productivity of debt. In the past, you borrow 1 unit of debt, you can create 1 unit of GDP. Now, roughly, you have to borrow 3 new units of debt to support the same creation of 1 new unit of GDP. So you put all of this together, it only means, going forward, the room for creating debt enough to support growth ain't there. It's not there. And therefore, growth will remain slow. So that's the third headwind. But more insidious and more troublesome is a longer-term development, which I say one is the slowdown in world trade, which emerging market countries are very dependent on, and second, what I call premature aging of emerging market economies. Look at commodities, it's under pressure, growth is lower, commodity price lower. The right-hand side chart is interesting. It shows the shape of the yield curves and commodity price. It turned out that they correlate pretty well. World trade's down. Left-hand side is export growth, negative everywhere in Asia. And you throw into the pot, China export declined by 11.2% in January year over year. Japan export declined by 8-9% year over year in January. It's a picture of collapsing of world trade. And one of the factors behind it is that China simply needs to import much less than before. They simply don't need a lot of things that Asia, including Korea, have used to export to China. And that is one of the reasons why you see on the left-hand side, export growth is collapsing. So commodity prices down, which is a major term of trade shock to emerging market countries. World trade is down. Productivity and labor force growth is also down. It's this estimate by JP Morgan, and our calculation kind of support these findings. We know that productivity growth has been slowing, but I guess not too many people realize that the deceleration in emerging market countries has been so pronounced. Go from 3.5% annualized growth to less than 1%. Very sharp deceleration compared to mature markets. Also, labor force growth is slowing. You put the two together, potential trend growth rate has been much slower than everyone has estimated. Again, JP Morgan last weekend come out with a new estimate for potential growth rate for the global economy, and they estimate it's now 2%. For the whole global economy, potential growth rate is 2%. And potential growth rate means that normally, in absence of any forces or action to stimulate it, the economy tend to revert to potential rate. So absence of anything, it's about 2% that we can hope for. And indeed, that is what almost every major forecaster expect the global economy to perform, about 2.3% this year. 2% is not recession. It is not that bad. However, if we have slow growth around 2 to 3% for the global economy for a long term, in fact, this year and next, we will have 6 years in a row that the global economy grow below 3%. Then you have all kind of social problem, political tension, distribution of the fruits of the economy. We have many sectors of the population feeling underappreciated and underpaid. So I think that we will continue to see more of these in the future. So I will conclude by offering this chart, which again summarizes everything that we have covered so far. The emerging market, mature market growth differential used to be very high. 5-6 years back, it's now going down. And of course, with that, the differential between emerging market equity valuation and mature markets also coming down. So I think that is the chart that will basically drive development that we will see in the period ahead. So I think that I use up most of my time for the presentation, so I would like to stop here and open the floor for your questions, comments.
Okay, thank you. Well, thank you very much. Good overview of particularly global financial terrain we have today. You know, as I was saying at the beginning, you must be really concerned about the current state of global economy and finance. And in fact, there are various developments and the economic and financial phenomena which are hard to explain with conventional wisdom or conventional theories. As Sung Trung mentioned in his presentation, Japanese central bank started to introduce a negative interest rate, but Japanese yen appreciated instead of depreciated. And also, since when the world really worried about the low oil price? Everybody welcomed low oil price, but today the world is concerned about low oil price, and in fact welcomed OPEC's agreement, which may not be held, but welcomed the agreement to reduce production rather than increase production. So we are living in this age where conventional wisdom as no longer can hold the water. And so the one thing is that we cannot see things in an isolated fashion. We should see everything in the global context, because everything is related to everything. That is why we see things happening which we're not quite used to. Well, with this, I'm sure you have many questions and comments on the Hong Tran's presentation. Why don't I invite comments and questions from the floor first? Yes, Dr. Kim first. Yes.
Thank you, Dr. Tran. Many of your charts show the emerging market and developed market. Now, unfortunately, what's happening in the emerging market today, I say, is two distinctly different forces. In other words, the countries which have been exporting the commodities, like raw materials, and they obviously suffer as a result of low commodity prices. But on the other hand, the huge economy of China should benefit from the lower price. And how do you see they are moving together in the same direction for the different reasons? And that when we see those charts, it's very confusing how to decipher this. Chinese have their own problems, which is distinctly different from the low commodity price. So how do you see Chinese market, particularly if you look at the return on equity and price to the book value kind of aspects? Thank you.
Okay, just Mr. Chen, please. Why don't you invite one? Yes.
I didn't hear anything positive this morning from your remark. So in an effort to find something positive, should we be looking for to see some hopeful? What would be the hopeful signs that this will end or this will turn around? Are there any such thing that we can look for? That's one question. Second question is, I noticed in your chart that listed bank price to book ratio. Interestingly enough, the country with the second lowest such ratio was Germany, right next to Greece. And many of us thought, Germany was doing well, its industrial economy is doing well. But then, we've been hearing about this problem with Deutsche Bank. So maybe there's something that we're missing. So what is it that we might have been missing? Thank you.
Right. So I just take the two set of questions and kind of weave them together. One, anything positive? Yes. One thing is that despite the very significant correction in the markets that has been going on for some time, overall market conditions remain orderly. So we haven't had a crisis in terms of disorderly panic and so on and so on. So that is a good thing, in the sense that, as I said, the banks are much better capitalized now than before. They have more or less implement most of the regulatory requirements that have been put in place in the past 8 years. So they are stronger capitalized, have better liquidity ratio management, and so on and so forth. So with that, it's helped to stabilize the system to the extent it has. Whether or not it will last is an open question, but so far we are lucky not to have a worse outcome. Going forward, is there anything that will turn this around? No. No, in the sense that you have too much debt. And anything that policymakers can do rely on creating more debt to support economic growth. Modern economy is a debt-driven economy. No debt, no growth. You have too much debt, you cannot borrow more. You cannot borrow more, you cannot have growth. Stop. There's nothing to be done about it. Unless you are willing to destroy debt and assets by default, but that also create a lot of suffering and pains on the part of the savers. People who save, buy government bonds for their own age and their retirement. If government renege and not pay the bonds, that reduce the debt, yes, but that also reduce the wealth of the savers. So basically, there's no easy way out. The only best way that can be hoped is not only relying on monetary policy, but have a very well-coordinated policy with fiscal stimulation where fiscal stimulation can be afforded. Not all countries are in the same predicament. For example, in Europe, Germany has excellent fiscal balance sheet at the moment. They can afford, they can use more fiscal stimulus to support growth. They don't want to do it, but that is a different question. And structural reform to create conditions for the economy and entrepreneurs to add value to society. But it really requires a degree of political leadership that we haven't seen for a long time in almost every country. So that is the potential solution and potential way out of this difficult situation. But personally, I think it's not likely. And in absence of such well thought out, coordinated policy, not only within countries, but among countries in the G20, in the absence of that, we are muddling through. Perhaps lack of big crisis is good news. But instead of big crisis, we have grinding, slow growth, and slow, long misery for many years to come. So no sudden death, but long misery. Oil import and export, that is one of the peculiar situation that Dr. Il Sagong referred to. Conventional wisdom is that oil price declines, the exporters suffer, the importer benefit. And in Asia in particular, net on net, many Asian countries are net importers of oil and energy. So therefore, Asia should benefit. But it hasn't. Why? Because it turned out that behind this is really this same thing of lack of growth, lack of demand, excess capacity, no demand. And therefore, even oil prices is low, interest rate is low, that has not stimulated consumption or investment. Whereas the oil exporters suffer directly because of reduction in fiscal revenue based on oil export. And they suffer in the Middle East countries and so on, in Russia. But the oil importers have not benefit in the sense of seeing their activity being stimulated. And what is the cause of this overall slowdown and lack of global demand and global growth? Well, economists are still debating it. My personal view is that we are getting into a situation of excess capacity on everything. Any manufacturer, consumer good, and you have everyone now have too many things of anything that anyone can wish to have. In the U.S., when I came to the U.S. to study in the 70s, one car garage. So a nice middle income suburban house, nice house, one car garage. Then 20 years later, 2 car garage. Now 3 car garage. Now 4 car garages. How many cars can one family thrives. How many flat screen TV can you have in your home? We are up to here with goods. And therefore, the delta, the new demand for many goods simply is not there. So the contradictory right now is that between stock and flow, the stock of wealth is very high. Many societies are much better off today in terms of stock of wealth compared to many years ago. But the flow, the delta, the new demand going forward is low. Again, like debt. You have too much debt, you cannot borrow more. You have too much stuff, you cannot buy more.
To follow up on Mr. Kim's question, I'm also desperate for good news this morning. My question is there any bright spot? You know, you mentioned a little bit about India. India is a net importer of all the commodities, and also they have a huge domestic market. Is that bright spot we're looking for?
Could you tell us who you are, please?
Oh, sorry. I'm Henny Purnamawati from Indonesia.
Okay, thank you.
Yes, it's all relative in the sense that within half an hour I cannot go into many countries, many specific conditions and so on. And therefore the overall impression is a bit negative. However, of course, there's always differences among different countries. Even the term emerging markets is misleading because it's, huge number of countries with different conditions, different stage of development, different policy regime, different quality of leadership, and so on and so forth. But having said that, yes, there are, from bottom-up perspective, there are effort or things that going in the right direction in some cases. India, you mentioned, since Prime Minister Modi came into power, there's a lot of clear narrative of reform to try to promote activity in India. They happen to have good central banker, which is keeping things stable for them. However, like in the case of Indonesia as well, policy intention, policy initiative is important. Narratives is important. However, at the end of the day, implementation is the key. You can have all kind of good policy you want. If you cannot implement it on time, then eventually the impact and the fruits of such intention is not coming. And India is a little bit in this area. There's something that have been done right. Still many things yet to be done. Corporate debt is relatively lower than that in South Korea and China, but still high, 85%. But within that, about 14% NPL among the state-owned banks. They have to take action to deal with that before the banks can be energized and support economy more. They have all kind of reform they need to go through, insolvency reform, land use reform, and so on and so forth. So at least we can say there's a narrative of intent to reform. There's some progress, but a lot needs to be done. And therefore, yeah, it's a work in progress. We can say the same thing about, let's say, Mexico, good policy regime under President Nieto, new initiative, energy reform, fiscal reform, education reform, but still work in progress and more need to be done. Outside of a few countries, then you can easily get into countries where many important reforms and measures have simply not been done. And they get into very difficult domestic political situation, which make the quality of economic policy even more difficult to achieve. So if you add all of the countries specific together, overall, you feel that it cannot overcome the overall structural headwinds that all countries have. All countries share declining in productivity growth. All countries have that. All countries, not all, but many countries share the decline in growth in labor force. All countries share the diminishing productivity of debt. Many countries have high debt. So given these common headwinds, the countries that have done relatively better than others are still being overwhelmed.
Thank you. You talked about impossible trinity in the case of China. And now, from this October, Chinese renminbi will be included in the SDR basket. And over the last several months, renminbi has already substantially depreciated. May I ask your view about the future course of renminbi and its value?
Yeah, I think that it depends on your perspective. If you go back for the back 3, 4, 5 years, then renminbi has shown a significant appreciation against basket of currency because they try to be closely pegged to the US dollar. And when the US dollar strengthened for most of, between 2011 until lately, renminbi also strengthened significantly vis-a-vis a basket. So the question now is, if you look at that with that long perspective, then weakening of the renminbi against the dollar is simply allow it to get back to a more neutral valuation vis-a-vis the basket, to unwind the past appreciation of the currency. And that interpretation is consistent with the fact that, the strengthening of the renminbi against the basket play a part in slowing down the economic growth, and therefore going forward, they need to unwind that headwind. Now, if that is the interpretation that you look at things, then there is room for the renminbi to weaken against the dollar a bit further to kind of offset the past appreciation. Another way to look at it is simply looking at the effort that the Chinese leadership is being confronted with in engineer a very difficult kind of transition to move from the old growth model, which is not workable anymore, relying on fixed asset investment and export via manufacturing export, because they are confronted with the same slowdown in world trade that everyone else is being confronted with, to domestically led demand and services economy while deleveraging the high level of debt that they have. It's a very difficult transition to make, and during that transition, growth will be slower. And the question is, can they make the transition, maintain slower growth, but in a very gradual manner to have a soft landing? So the chances are they can have a soft landing, but in the transition period, a lot of uncertainty. And that is behind the net capital outflow that many savers, starting with a very undiversified portfolio because they used to have nothing else but basically real estate and bank deposits as their assets, try to diversify their portfolio, and that prompt the ongoing net capital outflow. And that means the renminbi will have to weaken because of net capital outflow. So if you put everything together, it looks to me that the natural tendency, if the renminbi is free up and let it be dictated by market forces, the natural tendency would be to go further down.
Thank you very much, Dr. Tan, for your frank discussion. Me too, I thought it would have been better not to come this morning. No, I think I appreciate very much. Where does the money go which flows out of China and which has been flowing out of the stock market over the last weeks or months? Is there more to come also in the stock market? What would you see? You said so far, not bigger turmoil, but do you see potential for further turmoil in the stock market? Thank you.
Yeah, this is a very kind of complicated topic. Let's start from the basics. The basic is that China has been running current account surpluses since long time ago, since they began their reform and opening up. They consistently every year run current account surpluses. And therefore, cumulatively over the past 2 decades, own the current account surpluses every year, add together, put them in a very strong international investment position as creditor. They remain creditors. When we talk about capital outflow, we talk about private sector capital outflow, not the whole country. What we have seen is the public sector, Central Bank of China, selling reserves to support the currency, accommodate the outflow of the private sector. So while the Central Bank of China reduced their holding of foreign assets, the private sector increased their holding of foreign assets. Net on net, they are still the same international creditor they have always been. However, the selling of renminbi to demand dollars to buy foreign assets by private sector is what we caught in the net private sector capital outflow, and that is what drives the exchange rate and the financial markets. So yes, the near-term impact of net private capital outflow is unsettling for the currency and for the markets, but total picture is China is still in possession of the huge accumulated surpluses they have accumulated in the past 2-3 decades. They are still the largest international creditor nation.
Okay, Dr. Shen, another expert in the capital markets.
Oh, thank you. I just want to ask you, I'd like to ask you your view on the Chinese prospect of the Chinese economy, considering all these structural problems you presented to us. That IMF, I think their forecast was 6.3% for this year. I'm sure they will, revise down shortly. So what do you think of your view on it? And second question is, you mentioned briefly, but it didn't quite elaborate on the assessment of negative interest rate, its impact on the world economy and also Japanese economy. You probably have already answered that there is no way out of this deep problem. But how would you assess the cost and benefits of negative interest rates by central bankers?
So two questions, China and negative interest rate. China, as I said before, is going through this difficult transition. I think the leadership is aware of the need for it and what is required to do it. Implementation, as I said before, is always the key. It's not easy to navigate through these different conflicting demands. You have high level of debt. You want to support economy in the near term. That means you encourage more debt. That adds to your overall indebtedness and make it more difficult. So it's not easy to strike the balanced way to get through. The economy has slowly been transformed. The services sector is now getting to be growing and slightly more than 50% of GDP. The manufacturing sector is well less than 50% of GDP. So that is some proof that the economy is indeed being transformed. However, the problem with services sector is that it is why it offers a country more stable growth. It is slower growth. Services sector can never grow as dynamically, as strongly as manufacturing. It also offers lower wages compared to manufacturing wages. And therefore, for many emerging market countries, premature switching from manufacturing to services is a double-edged sword. On the one hand, at least they have something instead of nothing in terms of fuel up when the export demand is slowing. On the other hand, again, slow growth, low wages, low productivity. So if they switch to services too prematurely, it's not necessarily a good thing for them. The mature economies get to the point where they have high capacity and so on. They need to move to services, which is right, but that's why they have low growth. For emerging market countries to imitate the same response and the same development like mature economies is to condemn themselves prematurely to low growth rate, which will make it difficult for them to continue to modernize and develop their economies, which they still need to do. So I think that is a long way to say the slowdown is coming. The number that I look at is not the real GDP growth, but the nominal GDP growth, where the deceleration is very striking. On the chart I showed back in 2011, nominal GDP growth is almost 15%. Last year is 5.7% nominal GDP growth. Last year, nominal growth is lower than real GDP because China has a negative GDP deflator. So in an environment of negative inflation, deflation pressure, low inflation, it's, at least to me, nominal growth is something that people should focus on, not just the real numbers. And if you look at that, then it's really continue to be under pressure. Industrial production about 6%, but PPI continue to be minus 5.3% for 47 months in a row. That means in nominal term, industrial production of China is close to zero. And that explains the significant impact of the slowdown on demands of export from emerging market countries, not the slowdown in GDP growth. People say, well, 6.9% is still very strong for a big economy like China, so what's wrong with 6.9%? Many countries would have killed to get 6%. But the deceleration in nominal growth, which is the reduction in orders flow, in profits, in nominal terms, explain the impact on the rest of the world. Negative interest rate, I think it is, personally, I think it is not a good thing to do. It will get into all kind of big problems. At the basic end of it is the social contract between citizens and government. Why should citizens want to have their money being kind of confiscated and taxed by negative interest rate? Why should they just go ahead and organize payment system among themselves using bitcoins and blockchain and avoid negative interest rate by central banks? So I think central banks moving into negative interest rate, in addition to the perceived zero rate that I have conducted in the past 8 years, will increasingly run into big political and social resistance, and even their legitimacy could be put in question. So I think it's a very dangerous area for central bank to go. Also, it is not that effective. Again, depends on how do you define the challenge. If you think the challenge is excess capacity, lack of demand, then negative rates do not induce people to go and invest more. Because if you have excess capacity, you invest more, you create more excess capacity. That doesn't solve the problem. And therefore, monetary expansion at this point is like pushing on a string, like John Maynard Keynes has said. And therefore, it needs to be supplemented by other policy, fiscal policy, structural reform policy, which is more difficult to do. So negative rates are uncharted waters. I think it's very dangerous. And I think central banks should really pause and think carefully before they do more of this.
Well, don't be too depressed. In fact, he brought two news, one bad news and good news. And bad news is that the world economic and financial scene will be quite turbulent and volatile. On the other hand, the good news is there will be no hard landing and a big crash. And in fact, I wrote a column yesterday. I tried to present more cautious, optimistic view on the global economy and Chinese economy as well. He mentioned, and we all know that whether, Chinese growth rate will be, now, last year was 6.9%, but this year maybe somewhere around 6% level. One reason, one reason which gives me a little bit, take a little bit cautious optimism about China is China, fortunately, still has substantial policy room, space, in terms of fiscal policies and monetary policies and the foreign reserve, and it's compared to any other countries in the world. So there is still full of the arsenal, the instruments which can be used in case of crisis. And another thing is that based on my conversation with the senior officials in China, they all seem to know their problems quite well, and they are already taking actions. And you did mention that the Chinese so-called new economy, that is more on the service side, is doing quite well. Although, as you said, the service sector has relatively low, compared to manufacturing sector, has a low productivity. However, it's more jobs, sometimes high-paying jobs as well. And as you know, last year already, Chinese service sector in the GDP went up over 50%. We used to be below 50%. So what is called new Chinese economy start to work better. And then if you look at the shadow banking area, again, you can see that substantially the effect is already there. So, however, you can see so many problems there, is structural problems, particularly in the financial market. But I think they can be managed. It can be small, can cause various types of crisis, and by having the defaults and so forth, but no major crashes. That is the view, and in China. And then you look at the world economy as a whole. U.S. economy is 25% of global economy. Now, fortunately, U.S. economy is doing quite well. Of course, there are some people worried about this possible recession. But again, I think U.S. low oil price for U.S., in fact, and in macro terms, I think it will benefit in recovering the U.S. economy. So I don't see in near future there will be any recession in Europe. And then you look at the EU, which is about, Eurozone is about 16% of global economy. And you don't see there'll be a major crash there. And then you look at the Japan, which is about 6% of the global economy, which is the largest economy. But it's muddling through, and it will grow 1.5%. But it is very, paradoxical to see the Japanese yen appreciate when Japanese central bank implement a negative interest rate. What that means is that the global financial community and investors still see Japanese yen as safe asset. And that means that Japanese economy will not have any kind of collapse or anything. So they're safe there. And then you look at the emerging world, BRICS, for example, is only about 6 or 7% of whole global economy. And Russia and Brazil was minus 4% or so, which is bad. But it will not cause any systemic problem for the. So overall, we will have various problems and the local crisis, but fortunately, we will not have global scale crisis like what we had in 2007, 2008. However, there is a possibility, but in terms of probability is still quite low. And his presentation, again, made sure that there will be all turbulence. We should tighten our seatbelt and to expect turbulences, but no major crashes, which is good news. And anyway, particularly from his vantage point, I think from banking community's vantage point, I think there's more concerning thing. A negative interest rate, again, it directly affects bank profitability. But I think Japanese will continue to even further lower the negative interest rate in the coming months. And again, in March, ECB Mario Draghi will do the same thing. So they will try to do everything. The question is how good those policy measures will do to real economy. But anyway, at this point, we don't foresee any major crash. But which can happen, but probably is not that.
Yeah, I think I agree with that summary assessment of Chairman Il Saigon. We don't see a crisis like 2008, 2009. We don't see hard landing. But please keep in mind that, as I said, the global economy has been growing below 3% for 6 years in a row. When I joined the IMF more than 10 years ago, the rule of thumb at the fund is that we will have a global recession if global economic growth is below 3%. Now, if you ask the fund same rule of thumb, probably they say it has to be below 2%. But doesn't matter what terminology you use. The fact that the global economy, the whole global economy has been mirrored in such slow growth for such long period of time, and there's no end in sight. Next year, same 2.6, 2.7, 2.5%, the year following below 3%. And my concern is that this very long period of slow growth will damage many things in terms of, the animal spirit, the ability of economy to snap out of it. Young people do not have meaningful jobs, and so on and so forth. And more, the consequences will not be just economic, but more and more social and political, which we already have seen in Europe, in Asia, anywhere. So, yes, no crisis, no hard landing, but yeah.
And again, I read Lady Summers' another small piece on secular stagnation. And also he has an article, a long article in Foreign Affairs in the coming issue about the secular stagnation. He is quite consistent in foreseeing a very stagnant global economy unless the major countries do something more, particularly on the fiscal side. And again, it's quite consistent with what you are saying, and we are all concerned. And also, you see, this chart, the productivity and labor force, this is really mind-boggling too, because you see all these cellular phones and all this IT revolution and everything. But all this is not reflected in the productivity chart here. So the Mike Spence, who is a Nobel laureate, with whom I talked some time ago, he is one who keeps saying that we may have a problem in measuring productivity, and unless we change those statistical problems, it will take some time to see the productivity chart will be changed. But as of now, I suppose this picture, the chart may be paint the real picture. But I think in very near future, when the so-called fourth industrial revolution progresses and they get momentum, I think the productivity chart will look quite different. And so, the Robert Solow made a mistake in the early 2000s, and this productivity surge did come with this IT revolution. So this is another hopeful area to have the more optimistic view about the global economy from even medium to long-term perspective?
Well, I mean, of course, there's always potential problem for mismeasurement in economic data. Even the collection and compilation of GDP leaves huge area of uncertainty that can be improved. Nevertheless, 2.1 is the same methodology of national income accounting and calculation has been used by all countries for years and years and years. And this methodology did pick up the improvement in productivity growth around the late 1990s, early 2000, with the advent of the internet economy and .com. So the same methodology registered the improvement in productivity caused by technical innovation 20 years ago and failed to do so now. So basically, I think nothing wrong with the methodology. I mean, well, it can be wrong, but it is consistent. So you cannot, say, and secondly, productivity is residual. You measure growth in the economy, you measure growth in employment, you divide the two, you have the residual. Look at the U.S. economy is growing by 2.1% per year over the past recovery from 2009. And yet it creates huge amount of employment, reduce the unemployment rate to less than 5%. That means productivity per labor per hour work has to go down. You cannot have that meager growth, huge increase in employment without decline in productivity. That's just arithmetical certainty. So whatever you say, it is good to have employment, yes, but you have to acknowledge that productivity per employee, productivity per hour work has declined, and that contributes to the deteriorating of the fundamentals, which is really at the roots of our challenges.
Yeah. Okay, yeah, I don't want to drag on this, but what they are saying is, Mike Spence and Martin Feldstein and others are saying, is that the quality changes and all those are not reflected in the GDP. But in any case, so still, even if there is a huge productivity change, I don't think there's a big enough change the chart now. But in coming days, it will gather momentum. That's the point. Okay. Okay. Last comment. Yes. Yes. We have to let him go.
I'm not an economist, but yeah. This is something that's been bothering me a lot since 2008, because as the debt crisis and the financial crisis started unfolding in the U.S., and U.S. government started taking action, I think many of us in Korea must have had déjà vu, because, Korea went through a serious crisis a decade before then. IMF prescribed a very different medicine for Korea in 1997 and 98. And it didn't do the same, certainly for the U.S., because it didn't have the political, power to do that. So it was, as Helicopter Ben started printing money, I kept thinking, how is this going to all turn out for the U.S. as well as for the rest of the world? Now then later, Greece had financial crisis, and IMF prescribed a different set of medicine than it did for Korea. I'm sure there were reasons why it did so. Greece is part of the EU. It did not have its own currency, etc. But in a way, Korea, having gone through the crisis, we came back very rapidly. We suffered a great deal, but the suffering was relatively short. Now, what's happened over the last 7-8 years seemed to me that there's really no reward without suffering. Maybe the world is pretty strict and it's fair. If you don't suffer seriously, but for a short duration, you're going to suffer a little, but for a very long time. So here I think IMF maybe in a way failed as kind of a global regulator, Maybe there are reasons for that, but what do you think about that?
Yeah, very quickly, IMF is not a global regulator, so they don't have the mandate, they don't have the power, they don't have the authority to regulate anything. They only have the power to lend countries in crisis money on conditions of reform. And you put your finger on the key issues in the Asian crisis, in the Latin American sovereign debt crisis, in the Greek debt crisis. The problem is these countries have too much debt in a country, in a currency, not their own currency. So that becomes the hard constraint. You borrow too much dollars, your central bank cannot print dollars, then you have to shrink your economy, reduce the current account deficit to the extent that you can balance the income and outcoming of dollars, full stop. Because nobody gives you dollar free. So countries that run into foreign currency debt crisis have to undergo very painful shrinking of their current account deficit to live within their means, in the sense that they have to earn the dollars with which they import things that they need, no more. And that is very painful. Whereas the US is different. The debt is in the US dollar. And therefore the Fed can do whatever they want to do. So that's what I proceed to do. And so with Fed accommodation, QE, and zero rate, with fiscal stimulation under President Obama, $850 billion, with the stress testing of banks, pushing banks to deal with their non-performing loans and raise capital back in 2009. Those three major policy actions combined set the stage for the U.S. economy to recover from mid-2009 until now. And many other countries in Europe and elsewhere haven't done that. I mean, haven't done all three at the same time to maximize the interconnected reinforcing benefit of these actions.
Yeah, another one. Yeah, it's a quick one, yes. The last quick one.
Dr. Tran, I'd like to ask a question specifically modus operandi of Chinese banks. How seriously would they be affected if U.S. sanction against North Korea applies to the secondary sanction to the Chinese banks? Because I was quite surprised that when they did Bank Delta Asia, even U.S. was quite surprised because the impact was far greater than they anticipated. So I'd like to see your opinion on what would happen.
I basically will sidestep your question, but I want to point out that so far in my short presentation, I have not had time to point out another issue, which is geopolitical risks and these kind of events until recently have been perceived by financial market participants as isolated, as not really, impacting systemically the economy or the financial system, but now they do. Now they become interconnected, now they become cumulative, and therefore geopolitical events anywhere, Middle East, and then refugees to Europe, and then terrorist attacks in Europe, US, and then turmoil and tension in South China Seas. And all of that tend to be interrelated. And more, instead of, again, exploding into outright conflict, is being dealt with through economic sanctions. So using economic and financial means to address securities and foreign objectives. And that, by nature, will cause economic policies to worsen and economic outcomes to be worse than otherwise could be the case.
Okay, now it's about time to release Hong Tran now he is on his way to Shanghai. I just hope you advise Chinese officials who will host the G20. And G20 do need to take some leadership at this moment for the global economy. And so we are all disappointed by the G20's role last few years. I just hope that China do play leadership role, do something about the global economy and finance. Well, with this, we should thank Mr. Hong Tran for his very penetrating and insightful presentation. And as always, let's get him back as soon as possible when he's around this area again. Thank you very much.